Hey everyone and welcome. Today we're diving into one of the most commonly used and frankly, most important ratios in stock valuation, the price to earnings or PE ratio. If you're even remotely interested in investing in the stock market, understanding this metric is crucial. It's a cornerstone of fundamental analysis and can help you determine if a stock is potentially overvalued, undervalued, or fairly priced. So what exactly is the PE ratio? Simply put, it compares a company's stock price to its earnings per share. It tells you how much investors are willing to pay for each dollar of a company's earnings. Think of it like this. If you're buying a pizza, you're not just looking at the price, you're also considering how much pizza you're getting for your money. The PE ratio does the same thing for stocks. It shows you how much earnings you're getting for each dollar invested. The formula is straightforward. PE ratio equals market value per share / earnings per share. Let's break that down. The market value per share is simply the current price of one share of the company's stock. You can find that on any stock market website or brokerage platform. Earnings per share, or EPS, represents the company's profit allocated to each outstanding share of stock. This information is typically found in the company's financial statements. Let's look at an example. Let's say Company A is trading at $50 per share, and its earnings per share are $5. To calculate the PE ratio, we divide $50 by $5, which gives us a PE ratio of 10. That means investors are willing to pay $10 for every $1 of Company A's earnings. Now, why is this relevant, especially for investors in the US market? Well, the PE ratio helps us put a company's stock price into perspective. A high PE ratio could suggest that a stock is overvalued. Investors are paying a premium for its earnings. However, a high PE can also indicate that investors expect high growth in the future. Conversely, a low PE ratio could suggest a stock is undervalued, or that investors have low expectations for future growth. It's rarely a simple case of high is bad, low is good. Context is key. Let's compare two companies in the same industry. Company B is trading at $80 per share with earnings per share of $4, giving it a PE ratio of 20. Company C is trading at $60 per share with earnings per share of $3, resulting in a PE ratio of also 20. In this scenario, both companies have the same PE ratio, suggesting they are similarly valued by the market relative to their earnings. Now let's consider a different example. Company D has a PE ratio of 30, while Company E has a PE ratio of 10. This suggests that investors are willing to pay significantly more for each dollar of Company D's earnings compared to Company E. Perhaps investors believe Company D has stronger growth prospects, a more dominant market position, or a superior management team. Or maybe it's overvalued. That's where further investigation comes in. It's important to note that comparing PE ratios is most meaningful when comparing companies within the same industry. Different industries have different average PE ratios due to varying growth rates and risk profiles. For instance, a technology company might have a higher average PE ratio than a utility company. Tech companies are generally expected to grow faster, justifying a higher valuation. There are also different types of PE ratios you might encounter. The trailing PE uses earnings from the past 12 months. This is the most common type. The forward PE uses estimated future earnings. This can be more useful for assessing a company's potential, but it relies on analysts' forecasts, which aren't always accurate. Another thing to keep in mind is that the PE ratio isn't a perfect indicator. It can be distorted by accounting practices or one-time events. A company might have a temporarily high or low PE ratio due to unusual circumstances. That's why it's crucial to use the PE ratio in conjunction with other financial metrics and a thorough understanding of the company's business. Don't rely on it in isolation. Finally, consider the overall market conditions. During a bull market, PE ratios tend to be higher, as investors are more optimistic. During a bear market, PE ratios tend to be lower. So, It's useful to compare a company's P/E ratio to the average P/E ratio of the overall market. To quickly recap, the P/E ratio is a simple yet powerful tool for valuing stocks. It compares a company's stock price to its earnings per share, giving you an idea of how much investors are willing to pay for each dollar of earnings. A higher P/E ratio suggests investors have higher expectations for future growth, while a lower P/E ratio might indicate undervaluation or lower growth prospects. Remember to compare P/E ratios within the same industry and consider other financial metrics alongside it. It's a vital component of fundamental analysis. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.